Several indicators suggest Bitcoin is currently in the mid-cycle of a bull run. On-chain data, which tracks activity on the blockchain network, reveals that long-term holders are selling fewer coins compared to previous cycles. This stands in contrast to the 2017 bull run where long-term holders offloaded significant amounts of Bitcoin as prices surged. The current trend suggests these holders are exhibiting greater conviction and potentially anticipating further price appreciation. Beyond holder behavior, Bitcoin's price movement often correlates with global liquidity conditions. The recent launch of several Bitcoin ETFs in the United States has opened doors for institutional investors, injecting a surge of new demand into the market. These inflows contribute to upward price pressures. Additionally, the upcoming Bitcoin halving event, scheduled for roughly 60 days from today, will further reduce the rate at which new Bitcoins are created. This recurring halving mechanism inherently constrains supply, potentially leading to price increases as demand remains steady or grows. Looking at specific price predictions, notable analysts like Lynn Alden have projected a bullish outlook for Bitcoin. Alden's forecast suggests Bitcoin could reach at least $100,000 within the next 18 months. While such predictions should not be taken as absolute certainties, they represent informed perspectives from market experts. Investors can consider these forecasts alongside their own research to make informed investment decisions. It's crucial to recognize the broader economic environment when analyzing Bitcoin's potential. Analysts, again including Alden, warn of a potentially inflationary decade ahead. This concern stems from factors like expansive fiscal policies enacted by governments and quantitative easing measures employed by central banks. These interventions tend to increase the money supply, potentially weakening purchasing power over time. Bitcoin, along with gold, is often viewed as a hedge against inflation. Their limited supply makes them inherently resistant to devaluation, potentially preserving their value even as traditional currencies weaken. Beyond inflation, another key factor influencing markets is the increasing dominance of fiscal policy. Structural deficits, coupled with historically low interest rates, signify a shift away from traditional monetary policy tools. Investors should pay close attention to how fiscal policies, including government spending and taxation, impact market sentiment and asset valuations. Furthermore, the current economic landscape is characterized by persistently low interest rates alongside rising debt levels. This dynamic creates a challenge, as the ability to control inflation through adjustments to interest rates diminishes when rates are already near zero. Investors should monitor this interplay between interest rates and debt, as any significant shifts could have ripple effects on asset prices, including Bitcoin. This emphasis on fiscal policy necessitates a broader market analysis for investors. Traditionally, central bank actions were a primary focus. However, the current environment demands a deeper understanding of how fiscal considerations drive market sentiment and asset valuations. Investors who can effectively incorporate both monetary and fiscal factors into their analysis will be better equipped to navigate complex market dynamics. Another key inflation driver is the rapid growth of the broad money supply. This can occur through aggressive bank lending or large monetized fiscal deficits. When the money supply increases rapidly, it can lead to inflationary pressures. Investors should keep a watchful eye on indicators that track broad money supply growth, as they can signal potential inflationary episodes on the horizon. Traditional monetary tools may not be entirely effective in combating inflation fueled by large fiscal deficits. In such scenarios, Bitcoin and gold often gain favor as alternative stores of value. Their scarcity and resistance to debasement make them attractive assets during periods of inflation. Investors concerned about inflation may consider adding Bitcoin and gold to their portfolios as a form of protection. The long-term outlook suggests inflationary pressures are likely to persist, potentially resulting in a new economic normal with higher highs and higher lows compared to previous decades. This underscores the importance of incorporating inflation hedges like Bitcoin and gold into investment portfolios for long-term resilience and potential growth. Please go ahead by liking, subscribing, and sharing with friends to support our content. The information is for general purposes. Viewers should conduct research and consult professionals for financial decisions.